October 24th, 1929. Black Thursday. The New York Stock Exchange opens to a wave of panic selling that wipes out paper fortunes in hours. October 19th, 1987. Black Monday. The Dow Jones Industrial Average falls 22.6% in a single session, still the largest one-day percentage drop in Wall Street history. October 2008. The financial crisis, already underway since September, reaches its most violent phase. The Dow swings by hundreds of points almost daily, and the VIX, Wall Street's so-called fear index, closes above 80 for the first time ever. 3 different decades, 3 different causes, one recurring month. So every single year, the moment September ends, financial media reaches for the same headline. Is October about to crash the market again? Today, we are putting that question on trial. Is October genuinely the most dangerous month in market history? Or is this one of the most convincing illusions in finance? This is Market Files. Let's start with what's actually true, because this isn't just folklore. According to research from Hartford Funds, 5 of the 10 largest single-day percentage declines in Dow Jones history happened in October. 3 of the other 5 happened in March 2020 during the COVID crash. Outside of that one extraordinary event, October accounts for the majority of the worst single trading days ever recorded, and the most brutal stretch of 2008, all clustered in this one month. It's no surprise then that many traders quietly reduce risk heading into October. Portfolio managers de-risk, financial headlines multiply. The fear becomes almost self-fulfilling. But here's the twist the headlines usually skip. When you look at October's average monthly return, not its worst days, its average, the story flips completely. Let's test 3 competing explanations, one at a time. Theory 1. October is statistically the worst month for stocks. If that were true, 100 years of data should show October losing money more often than other months. It doesn't. According to data compiled by CFRA and reported by Reuters, since 1945, the S&P 500's average October return is actually around positive 0.9%. That's stronger than February, May, June, August, and notably stronger than September, which carries the worst average return of any month on the calendar, roughly negative 0.6 to negative 1.2%, depending on the data window used. RBC Wealth Management pulled data going back to 1928 and found something similar. September averaged a 1.2% decline, the single worst month on the list, while October actually averaged a positive 0.5% return. September has also finished negative in roughly 55% of years since 1928, a losing record no other month comes close to matching. And this isn't just a US quirk. The same September weakness shows up in Canada's TSX, the UK's FTSE All Share, and Hong Kong's Hang Seng, according to the same research. Say that again slowly. September, not October, is the historically weakest month for the stock market. October just has the more famous scars. Theory 2. This is pure coincidence. Our brains inventing a pattern that isn't really there. There's a real, well-documented psychological mechanism behind this. The availability heuristic. Our brains rank the importance of an event by how easily we can recall it, not by how statistically common it actually is. A single legendary trading day, a 22.6% collapse in an afternoon, is infinitely more memorable than 11 other months of unremarkable, grinding, single-digit dips. So when 3 of history's loudest crashes happen to fall in the same month, our minds quietly rewrite October's reputation, even while the underlying average return data says otherwise. But there's a theory 3. And this is the one that actually holds up under scrutiny. Real structural, calendar-driven pressure. Fact. The fiscal year for a large share of US mutual funds ends on October 31st. In the weeks leading up to that date, fund managers frequently sell losing positions for tax purposes and window dress their portfolios before year-end reporting. That selling pressure is real. It's documented by RBC Wealth Management and others, and it typically peaks in September and bleeds into October. On top of that, trading desks come back from summer at low volume, and by September and October, full institutional participation returns, meaning any real economic stress that was quietly building over the summer suddenly has enough trading volume behind it to move the market violently. There's a fourth wrinkle worth mentioning too: election year timing. Research on the 4-year presidential cycle shows that midterm years, in particular, tend to carry the largest average intra-year drawdown of the cycle, historically bottoming somewhere in that August to October window as policy uncertainty peaks before votes are counted. That's not superstition. That's investors genuinely repricing risk around a real dated event. And here's the part that rarely makes the headlines. The same research shows the S&P 500 has been higher 12 months after every midterm election since 1950. So even the scary structural pattern resolves itself. It just doesn't resolve itself by Halloween. Time to go to the actual case files, one crash at a time, because the causes matter more than the calendar. 1929. The crash wasn't caused by October. It was caused by a multi-year speculative bubble, fueled by investors buying stocks on margin, sometimes putting down as little as 10% of a stock's price and borrowing the rest. When confidence cracked, those margin calls forced a cascade of selling that October simply happened to detonate. 1987? Same story, different mechanism. The Breedy Commission, which investigated the crash afterward, pointed to a relatively new technology at the time: computerized portfolio insurance programs that automatically sold stock index futures as prices fell. Those programs fed on each other, turning an ordinary correction into a one-day 22.6% free fall. 2008. This one's the clearest case of all. The acute phase of the crisis actually began in September, when Lehman Brothers filed for bankruptcy on September 15th. October wasn't the cause, it was the aftershock. Credit markets froze, banks stopped lending to each other, and by October 24th, the VIX hit an all-time closing high near 90, a level of fear the market had never recorded before or since at that point. The Dow itself tells the story in numbers. October 2008 saw the index lose roughly 14% for the month, one of its worst Octobers on record, including a single day, October 15th, where it dropped more than 700 points. But the fuse on that bomb was lit months, even years earlier. Years of subprime mortgage lending, mortgage-backed securities rated far more safely than they deserved, and a banking system carrying far more leverage than it could survive losing. Notice the pattern. In every one of these cases, the real damage, the bubble, the leverage, the systemic failure, was already built before October arrived. October didn't create the danger. October is simply when markets had enough volume and enough investor attention for existing danger to erupt visibly. There's also a technical wrinkle worth clarifying because it trips people up. Biggest crash can mean two very different things. Do you mean the largest single day percentage drop, or the largest peak to trough decline over weeks or months? The 1987 crash wins on the first measure. Nothing has ever matched a 22.6% single day fall. But the 2008-2009 bear market, measured peak to trough, actually lost more than 50% of the S&P 500's value over roughly a year and a half. And that damage wasn't concentrated in October at all. It unfolded over 18 brutal months, well into March of 2009. Even 1929 gets flattened by memory. The market didn't just crash for 3 days in October and stop. It kept grinding lower for nearly 3 more years, ultimately losing close to 90% of its value by the summer of 1932. October 1929 was the opening scene, not the whole movie. So theory 1, October is statistically the worst month, is disproven by the average return data. Theory 2, it's pure random coincidence, doesn't hold up either, because October's volatility, not its average return, genuinely does run higher than most other months, largely due to that late year positioning pressure. The truth lives in theory 3. October is a high volatility, high attention month layered on top of whatever risk already exists underneath it. So here's the actual reveal. October doesn't cause crashes. October is a stage, not a script. When real economic or financial fragility already exists, excess leverage, a credit crunch, an overheated bubble, October's return of full trading volume and fiscal year-end selling pressure gives that fragility room to erupt dramatically. Think of it like a pressure valve. Whatever imbalance built up over the summer, cheap debt, stretched valuations, hidden risk in one corner of the financial system, doesn't wait patiently for a specific date. It releases whenever trading volume, investor attention, and institutional selling pressure all happen to line up. It just so happens that late September into October is one of the few windows on the calendar where all three of those forces reliably converge at once. Take away the underlying fragility, and October is just a month. In fact, per Hartford Funds and CFRA data, More Octobers have finished positive than negative across the last several decades. Most Octobers are boring. We just don't make documentaries about the boring months. So, what does this actually mean for you as an investor or trader? First, don't manage risk purely off a calendar date. It's October, sell everything. Ignores the actual data. October's average return is historically positive, and September has the worst track record by nearly every measure. Second, if you're seeing real warning signs heading into autumn, stretched valuations, aggressive margin debt, credit stress, deteriorating earnings, then extra caution is reasonable, not because of the month, because of the fundamentals that October's volume simply makes more visible. Third, and this is the real takeaway, famous crashes are famous because they are dramatic, not because they are representative. Memorable and statistically true are two completely different things. Every time you hear a market myth, October always crashes, sell in May and go away. Don't take it on faith. Pull the actual numbers yourself. Because the real edge in this business was never just knowing the patterns. The real edge is knowing the difference between a genuine statistical pattern and a story your own memory is telling you. Fourth, respect the difference between volatility and direction. The data says October runs hotter than most months, meaning bigger daily swings in both directions. But that heat doesn't reliably point downward. Bracing for a crash every October year after year means sitting out roughly 40 years worth of Octobers that mostly went fine, just to avoid the handful that didn't. Fifth, and this one's for anyone actively trading rather than just holding. If you do choose to reduce exposure heading into fall, do it because your own risk model says so. Position size, stop losses, portfolio concentration, not because a countdown on a calendar app told you to. A rule that isn't grounded in your actual portfolio isn't risk management. It's a habit wearing a risk management costume. And finally, history's real lesson from 1929, 1987, and 2008 isn't avoid October. It's avoid leverage you can't survive losing and avoid ignoring stress that's visibly building in the system. Every one of those three crashes gave investors warning signs for months, sometimes years beforehand. October didn't blindside anyone who was actually paying attention to the fundamentals underneath it. Next time on Market Files, 72 hours inside a margin call. A hedge fund pushed to the brink of collapse over a single position in just 3 days. This time, we go inside that story. I'll see you in the next one.